Index funds are boring, that is their strength. They do not promise overnight riches, they do not trend on social media. No one brags at dinner about their thrilling position in a total market ETF. And yet, index funds have quietly built more real wealth than almost any investing strategy available to regular people. So why say you are wasting time on them? Because most people misunderstand what index funds are actually for. They treat them like a shortcut to wealth, a passive money machine, or a replacement for a plan. Then they get impatient, or worse, they get distracted. If you own index funds but do not use them the right way, you are not investing, you are just parking money and hoping. Here's what most people get wrong and what you need to do differently. The lie people tell themselves. I invest in index funds, so I am set. That belief feels responsible, it sounds smart, it checks the personal finance box. But investing in index funds by itself is not a strategy, it is a tool. Buying a total market fund once and occasionally adding a little money is not the same thing as building wealth. Without a system around it, you will drift, you will panic during downturns. You will chase other ideas when the market feels slow. The truth is simple, index funds only work if you combine them with time, consistency, and a clear purpose. Without those three things, you are wasting years. What index funds actually do? An index fund does one thing very well. It gives you broad exposure to a market at very low cost. That is it, if you buy a fund that tracks the overall stock market, you are buying small pieces of hundreds or thousands of companies. You are betting on long-term economic growth. You are not betting on a single company or a clever manager. Over long periods, that has historically worked, markets rise as businesses grow, innovate, and produce profits. But notice the key phrase, over long periods. Index funds are not designed to make you rich in 3 years. They are designed to steadily compound wealth over decades. If your expectations do not match that reality, you will get frustrated, and frustration leads to bad decisions. The real problem: impatience. Most people do not fail with index funds because the funds are flawed. They fail because they expect excitement. They check their balance every week, they compare their returns to a friend who bought a hot stock. They read headlines predicting crashes, they watch influencers flashing screenshots of massive gains. Index investing feels slow next to all that noise, so they start tinkering. They move money in and out, they hold cash waiting for a better entry point. They add speculative picks on the side, they try to time downturns. Each small decision feels harmless, together, they sabotage compounding. The biggest advantage of index funds is that they remove the need to be clever. When you constantly override that simplicity, you give up the advantage. You are wasting time if you are not aggressive with contributions. Here's the part people rarely talk about: your rate of return matters. But your savings rate matters more, especially in the early years. If you invest $200 a month into an index fund and earn an average return of 8% per year, you will build wealth, slowly. If you invest $1,000 a month at the same return, the outcome is completely different. The fund did not change, your behavior did. Many people obsess over which index fund to choose while ignoring the bigger lever. How much are you actually putting in? If your contributions are small and inconsistent, you are stretching the timeline unnecessarily. Index funds reward scale. The more money you consistently invest, the more compounding has to work with. Unless you are steadily increasing your contributions as your income grows, you are leaving the most powerful part of the strategy unused. The missing piece: a defined end goal. Ask yourself a blunt question: what is this money for? Retirement at 60? Financial independence at 45? A house in 10 years? Optional work in your 50s? If you do not know the target, you cannot reverse engineer the plan. Index funds are neutral, they do not know your goals, they simply track a market. You need to decide how much you need, by when, and what level of risk you can tolerate along the way. For example, if you want $1.5 million in 25 years, you can estimate how much you need to invest each month assuming a reasonable return. Now your index fund has a job, it is not just sitting there, it is part of a plan with numbers attached. Without that clarity, you will drift for years, adding money when it feels convenient and pulling back when it feels scary. That is not investing. That is reacting. Unless you do this part, so here it is. You are wasting time on index funds unless you turn them into an automated wealth building system. Not a casual habit, a system. That system has 4 parts. 1. Automate everything. Set up automatic contributions from every paycheck. Do not rely on willpower. Do not wait until the end of the month to see what is left. Treat investing like a bill that must be paid. When the money moves without you thinking about it, you remove the biggest obstacle, yourself. Automation turns investing from a decision into a default. 2. Increase contributions with every raise. Every time your income increases, your investments should increase too. If you get a 5% raise, consider sending at least half of that raise directly into your index funds. You will not miss money you never get used to spending. Over a decade, these small bumps create massive differences in your portfolio. Most people upgrade their lifestyle with every raise and keep their investments flat, then they wonder why their progress feels slow. 3. Ignore short-term noise. Markets will fall, sometimes sharply. When that happens, headlines will sound dramatic, people will predict recessions, crises, and worse. If you are invested in broad index funds, downturns are part of the deal. The only way the long-term average return shows up is if you stay invested during the ugly years. This is where many people quietly waste time. They invest for 5 years, panic during a crash, sell, and sit in cash. Later, they re-enter at higher prices. The clock resets. Time in the market only works if you actually stay in. 4. Measure progress annually, not daily. Checking your portfolio daily makes normal volatility feel like danger. Instead, review your investments once or twice a year. Look at 3 things: total balance, total contributions for the year, and progress toward your goal. If the system is running and contributions are increasing, you are on track. Daily price swings are background noise. When index funds are not enough, there is one more hard truth. If your income is low and your expenses are high, index funds alone will not save you. You cannot invest your way out of a weak cash flow situation. In the early stages, your primary focus should be increasing income and controlling lifestyle inflation. A person investing $300 a month at a high salary ceiling will struggle to build serious wealth quickly. A person who aggressively grows income and invests $2,000 a month changes the trajectory entirely. Index funds amplify what you feed them. If you feed them very little, they grow very little. So sometimes the best way to improve your index strategy has nothing to do with funds at all. It has to do with skills, career moves, side businesses, or negotiating pay. Speculative investing feels fast because the feedback loop is short. Prices jump, screens flash green, stories spread quickly. Index investing feels slow because the feedback loop is long. Years pass, gains compound quietly, there are no dramatic spikes most of the time. But over 20 or 30 years, the slow path often wins. Not because it is magical, but because it is sustainable. You can stick with boring, you can automate boring. You can increase boring contributions every year without stress. You cannot reliably repeat lucky stock picks for decades. A simple example. Imagine 2 investors. The first invests $500 a month into a broad index fund for 30 years. They increase contributions by 3% per year. They stay invested through every downturn. The second invests $500 a month too, but they frequently pause contributions when the market drops. They move to cash during scary headlines, they chase trends. On average, they miss some of the market's best recovery months. Even if both technically use index funds, their outcomes will be dramatically different. The difference is not intelligence, it is behavior. Compounding rewards consistency more than brilliance. The long game mindset. If you are going to use index funds, commit to the long game. That means thinking in decades, not quarters. It means understanding that a 20% drop is painful but normal. It means seeing contributions as seeds you plant today for shade you will sit in years from now. It also means accepting that you will probably not outperform the market, and that is fine. If this video helped you see index funds in a new light, that's exactly why I made it. Building real wealth isn't about chasing the next hot stock or timing the market perfectly. It's about having a simple plan and actually sticking to it. If you're serious about growing your money the smart way, you're in the right place. If you got value out of this video, don't forget to like, subscribe, and turn on notifications so you don't miss the next one. Drop a comment below and let me know, what's your biggest investing challenge right now? See you in the next video.